I don't like the general situation, but it's nice to be with the people that you love, and this is some of the lessons that we got, I think, from this disaster, corona disease. That if something is that I learned from it is to be with the people that's really important to you. And unfortunately, my parents is alone, and it's more safe for them. And I hear that in the States, especially New York, the situation is terrible. And I want to share in grief with so many families that lost their relatives, and wish the the people who are right now sick to be well as soon as possible, all over the world and especially New York.
Definitely very difficult times. It's now a point in time in the United States that's most of us are a link removed from somebody who's affected by the coronavirus, and it's just moving extremely rapidly. But thank you for pointing out the silver lining. It does create a lot of relatedness and closeness. We're sitting together in the same space, exploring the great indoors together. Uh, Something that typically happens around holidays. Now we see families and kids and everyone have to sort of like deal with what is. Israelis have always been very, very resilient to all sorts of catastrophes. Can you share with us a little bit about that, about the Israeli spirit? Aaron, can you hear us?
That the Israeli spirit is, yeah, I can hear you. Can you hear me, Joe?
Yes, we can hear you fine.
I have some. It's okay.
Now we
It's
can
okay.
hear you. Now we can hear you fine.
No, in and out.
Okay. Okay. So yes, I think that the Israeli society is criticized by a rapid of adapted to a change. We used to adapt the situation, and because we are a society that of people who knows came with a background, with historical background of change countries, change cities, change political situation, and after 2000 years, we established our country. So Israel is as a nation, we like to be, we like the innovation, and the innovation is give you a good beginning to when you have some catastrophes or you have a crisis like this, you know to how to be more flexible, and to know how to find a way to adapt the situation. I always say that Darwin, not me, said that it's not the strong person who survive. It's the ones that can quickly adapt the change that's thrive. And I think this is the situation now. And I think the people here in this meeting, they are not only executive managers. I think the people here is now in this situation, they must be leaders. And it's really different between CEO to a leader, because most of our employees and the people who work with us, and of course our family, is looking for someone who leads them, someone who gives them the inspiration that this is not the end of the world, and this is not the end of the world. We are going to see. I'm sure that we are going to see the beautiful blue skies when. And I think that this situation of the corona give to every business around the world, give the opportunity to calculate is passed away again. And for example, I have a big college in Israel for real estate and design and construction. And for a few months, few years, I tried to go to make an e-learning there with the Zoom or whatever other technology. And when the Corona, we understood that there won't be any study in the classroom. In one day, we bought the technology and we had a we had online college. It's of course it's not so easy. It took, but every week it's becoming better and better. As well in Israel, we had the potential as the Israeli Real Estate Center. We had the potential to establish something new. We have a conference, a big conference in Israel, and of course one in New York with the great people that I see here. But we decided to take the opportunity in the in the Corona crisis, and we make a Zoom conference every day. We have between 3 to 5 round table like this with the top decision makers in Israel and from the States as well, and with a lot of audience. Sometimes we had 300, 400, 200 audience. It's amazing. People have time now, and we do it for free. We are not charging nothing for it. We are doing because this is the part of the obligation to the real estate community in Israel. So I think that every business like us have an opportunity as an opportunity to think out of the box and to find a new way. I'm sure that the Zoom and all the other technology that we use them now, they won't disappear after we finish the crisis.
Thank you for that. I think the startup nation, no doubt, were very resilient, very much adaptive to change. Israel has phenomenal human capital. It's just the story of us, the story of having to pick up and move, and it happened one generation to the next. So I think, not comparing at all anything that had to do with our past, but nonetheless, I think, we're very people. Your business is a conference business, essentially, of people's business. Do you see the conference world coming together anytime soon? The other day, I saw a show of the Rolling Stones. There were 200,000 people screaming and singing along in a huge hall. Do you see those things coming anytime soon? And what about Eilat? What are the plans for the greatest real estate conference, the annual real estate conference that the Israeli Building Center is conducting every year? What are the plans for that?
Okay, I think that it will take time. It will take time. I think the world, and especially America, we will have to slowly to come back to the regular life. And I'm sure that the conference all over the world, and it's something very important for the business. People brand themselves in the conference. People doing a lot of business in the conference, and I think that it will come back. I think that our personal big conference in Israel, in Eilat, in the Red Sea, with 4,000 participants. It's the biggest conference in Israel, not only in real estate. It's in December, so we have to thank God that it's not next month or in 2 months. In December, I believe that it will be okay. But you cannot close Las Vegas, I think, Joe, or Miami, Orlando, or New York.
Vegas is closed. I'm sad to report Vegas is closed. Or a month from now, we were supposed to go to our annual ICSC conference. That's a conference that brings 72,000 participants. It's a real estate conference, a 3-day. It's probably the biggest in the world. And 3 weeks ago, I think, maybe even a month ago, there was an informal message from the ICSC that it's not happening. So first, we have a lot is coming up in December, so we certainly have some time. We hope to find a new norm. But I appreciate your optimism. I'm definitely there with you. The world will go back to normal. We'll see what the new normal. We're going to ask the folks on this call what the new normal for them is. But nonetheless, appreciate your comments and thank you again for taking the time.
My only problem is that I cannot meet my hair designer. So so I have a problem with my hair. So otherwise, I think it's we have to, to be pessimistic, optimistic. It's the same. You just have to decide what you want to be. You cannot change the situation. So we have to be optimistic, especially if we are in a high position in our business, in our organization, and take the organization to the future, because there will be the day after the corona. So I want to bless everybody. We have a holiday, Pesach and Pascha, and I want to I just want to finish and to say that twice during all the year, all the 3,000 years, there was twice that people made the Pesach dinner only with the Sid family. It will be tomorrow in Israel, and it was in the night before in Egypt, before 3,300 years, 32 years before they go to the desert. So this is the second time that we will have the Pesach dinner only with our Sid family, not with all our big families. So
definitely will be a Passover we're not gonna forget. That's for sure. I don't think in our lifetimes we're seeing some pretty severe things. The 2008 grand crisis and now this. But one thing for sure, a lot of us over here in this conference are and have went through some pretty turbulent times, came out very successful. Some of us even came out stronger. Thank you for that, Eran, and Chag Sameach to you and to everybody else who's listening in Israel. The stock market in the United States has closed at the lowest low it's seen since 2008. I think I'm really happy to see that the Fed's Congress has come together in a very bipartisan way to pass the biggest stimulus package in the history, the $2.2 trillion. People sometimes don't have a point of reference to what that number actually means. $2.2 trillion is actually larger than the GDP of Brazil. So it came very, very quick, and I think it's going to make a nice impact, a significant impact. And certainly, we all hope that things will start stabilizing. Will help this economy tremendously. I'd like to go around and ask our participants to introduce themselves. We'll start with you, Anna. Please say a couple of words about yourself, about your operation. And we'll move on one to the next.
Sure. So my name is Ana Rodriguez. My company is owned by me and my brother Oscar. Our company name is Arena Capital. We do real estate development in the retail and multifamily sector, as well as repositioning. When we talk into the retail, we usually look into doing stuff for the middle to lower income class. So think about Dollar Trees, Family Dollars. That's kind of where our shopping centers are. And when we talk about multifamily, we are in the true workforce housing. So the nurses, the policemen, your service people, your waiters, those are our tenants. We're based in Florida, and all of our properties are here in Florida.
Thank you, Anna. Jerry, hope you're well, hope the family's well. Would you take a moment and introduce yourself, please?
Sure. Jerry Karlik, JK Equities. We're a family-owned business. My son and myself, Jordan, are the two principals. And we are mostly in the multifamily and mixed-use development business. And we are in the process of developing two projects in Chicago. One is a major high-rise, and the other one is a smaller boutique condo building. Both of these are for sale products. And we're also developing a rental project in Roslyn, New York, which is my neighborhood where we live. And it's a transit-oriented development, a rental mixed use. And we're going through the painful zoning process, which is about, we're going to hit 2 years this July or August that we've been involved in this rezoning. But we are, as developers, we are optimists by nature. And to be a developer, you have to be an optimist. And we're very optimistic about the future. I think things are going to change. Not sure exactly how, but we're small and agile, and we can adapt quickly, and we have been adapting quickly.
Thank you, Jerry. Certainly hope so, and hope for better times to come. Ariel Tirosh is with us. Douglas Salomon. Ariel, good afternoon.
Oh, here we are. Hey guys, how you doing? Great seeing you. Chag Sameach lekulam. Really great seeing the gang. Everybody's here. My name is Ariel Tirosh. I am located in Manhattan. I'm a real estate broker. I have a team of brokers in the city. We do the marketing of mostly new development condominiums. So there's a lot of relevancy to our conversation today. And I hope that we're all going to make it on time to Iran's conference in December in Eilat.
Amen to that. Diego Bonet, can you hear us?
Hi, Joe. Yeah, can you guys hear me?
Yes, we can hear you fine. How are you?
Good. I'm Diego. I'm based out of me. We have two businesses, real estate development and investment business, Linear Group, and construction and architecture business, Linear Designs. In total, we have a team of about 15 people. On the architecture and construction side, we've been around for about 10 years. On the real estate side, we're a bit younger. We've been around for about 4 years. We're currently working on two development projects, one in Miami called Wynwood House. It's 224 multifamily units, and one in West Palm Beach. It's 200 hotel keys and then about 120 multifamily units on top of that. In addition, we have some cash flow generating properties in South Florida, and we're also looking actively at value add deals in Central and West Florida.
Mm-hmm. Thank you for that. Talk about the hotel industry. I think that's definitely an industry that has been hit significantly. Michael Corrine, Astor Realty Capital, calling from Phoenix. Michael, how are you?
Hi, thank you, Joe, and hi, everybody. Chag Sameach to everyone. I'm Michael. I am a partner at Astor and also Joe's partner at Burke & Associates. I run the capital markets team for the firm over there. So basically, we have, we're talking to everybody with regards to the projects that we have in place. The speakers are all people that we're dealing with actively, and I will be addressing those. One last comment. Iran, I'll introduce you to my hairstyle. I'll still solve your problem for you.
Thank you, Michael. Dvir Cohen-Hoshen calling from Israel. How are you, Dvir?
Hi, everybody. Everything is good by us here. And I think our country is handling the situation pretty good. And hopefully New York will follow and will recover soon and we could fly back and run the business there.
So you have projects in New York, you have projects in Connecticut.
Yes, New York, Connecticut, Miami,
and
we have also Berlin, Germany, which is also
our
and also in Tel Aviv.
Also in Tel Aviv.
And in Tel Aviv. Good. So we'd love to hear a little bit about general view from you. Michael Dinowitz. How are you, Michael?
Hi. Hey, Joe. Hi, everybody. I am a senior partner at the Midtown Manhattan law firm of Elinoff, Grossman and Scholl. I'm in the real estate group. We are about 100 lawyers. We have a very large corporate and securities practice. We have big commercial litigation practice, technology and patents, labor and employment, tax, and some other areas. As I said, I represent developers, owners, and investors throughout the United States and internationally in real estate investments and projects. And you know, we are certainly in new territory here, but we've basically seen all the themes before. When you're around for 33 years, like I've been, we've been through at least 3 or 4 cycles. Obviously, this presents some novel issues, but we are resilient here in the U.S. too. We'll get through it, and we'll hopefully see you on the other side in December in Eilat.
Thank you, Michael. And then David Brickman. David also from New Jersey. David, how are you? How's the family?
Everyone's well, Joe. Thank you. Yeah, we're from Onyx Real Estate Partners. We are developers, primarily in New York, but also now a little bit in New Jersey. Developing mixed-use projects are under construction. Currently with one mixed-use project that I guess we'll talk about what we're doing now. But everyone is healthy. It's the most important, and look forward to this discussion.
Wonderful. Thank you very much, everyone, for introducing yourselves. I'd like to start with first question out to Anna. You manage a portfolio of several hundred workforce housing, essentially the most delicate segment, the segment of individuals that probably have seen a good or a large wave of firing, losing their jobs. How do you manage to run a real estate project when you know that a good segment, a big percentage of your tenants might be out of work?
So we've been working with them on a case-by-case basis. So although some of them are losing their jobs, some of them are finding other jobs or new jobs with Amazon fulfillment centers and things like that. What we've been trying to do is for those tenants are current in rent and that have come to us and said, hey, I lost my job. We've been partnering with a couple of different nonprofit organizations like the United Way, Hands, Camila's House, just to get our tenants in front of the door and in front of the line to get help from these organizations. Some of them are actually giving 1 up to 2 months of rent to the tenants as long as they show that they have a 3-day notice, which we're being providing to them so they can do that. So we're going to start seeing some of our tenants starting to pay rent with nonprofits. What we've been doing also is trying to get our multifamily vacant units put a little bit more of Section 8 tenants, because that's the government who's been paying for those, and a couple of other nonprofits who pay, like Volunteers of America and the Veterans Association, who pay for tenants' rent. One thing that we'll see and we'll know more of for the multifamily will be April and May, when we're going to start seeing those people who are going to try to take advantage of the government saying, hey, you cannot evict people, and they're just going to say, you can't evict me, I'm just staying here for free and not doing anything. So I think you're going to see some very proactive tenants finding help or finding new jobs, and you're going to see some who are just going to try to take advantage. And what we've been trying to do for that is asking them very nicely that if they're not going to pay and are not willing to pay and are not willing to get help, then that we're willing to give their deposit as long as they give the unit back to us. So it's something that is evolving, and we're going to see more of what's really going to happen towards the end of April and May.
Thank you. Thank you for that. No doubt some will try to take advantage and some will be in real acute crisis mode. And you got to be very, very delicate in the approach. Very interesting to see how the municipalities will help out. Jerry, you have projects that you're developing in major city centers where Astor is involved with you in one such project in Chicago, in the West Loop, or building with you 72,000 square feet. But you're also very active in suburbs, suburban projects. Where do you see the market demands for housing reverts to less dense suburbs? Do you think there's going to be a trend like that?
I do. I actually, well, I have really two thoughts, but what I'm seeing now is an interesting trend. My son, I have sons who are just married or been married for a while, but they're young and they're in their 30s, and their friends seem to be migrating and asking to move out of Manhattan, especially if they have children, and move to less dense areas. So while there's been a migration from the suburbs by young people into the major cities, I think that trend may change, and that suburban housing, especially in good neighborhoods with good school systems, are going to benefit by that. On the other hand, I also think that memories are short, although this is a terrible crisis, as we all know. And I think a year or two from now, people will migrate to the same place they were before. So I've got sort of mixed feelings about it, but I think that the suburbs are going to become the suburbs that have suffered over the last couple of years with the fact that the housing prices have gone down in certain areas and gone down 15-20% from the highs of 2017 and 18. I think those numbers are going to start coming back up. I think the home builders, the tract home builders, are going to do very well. And I think that's going to continue for a little bit. But I still have hope, and I still feel that people don't want to commute, and they will take advantage of living close to their jobs. So I think there'll be the best of both worlds in the future. And I think we're going to try to take advantage of both sides of this. And we're very active right now and looking for some additional, believe it or not, we're not looking to fire, we're looking to hire, because we feel that the opportunities are going to be there once this crisis is over. And we think it's going to be, we don't really know, but in the next few months, things will change, and we don't know how quickly they'll change, but there'll be plenty of opportunity, we feel, to get into different markets and take advantage of some of the softness in the market that's going to come out of this crisis.
It's interesting. It could be that the suburban office market, which I think many of us have sort of like a red Kaddish on in 2008, 2009, those were hit very, very hard. Could be that we'll see a comeback into the suburban offices. Certainly some off-location. You might be right. Folks will have it less commutes, maybe some changes in that respect, and staying outside of cities could be a new trend. David, you're also looking into a project that you're now completing in Queens. You've topped off a couple of months ago. You're going through the punch list now. It's 108 units in Queens and Northern Boulevard. How do you manage a construction project during this pandemic? What is the biggest short-term challenges you see in the current construction environment?
Sure. So we because we have affordable housing, we have 30% affordable in this project. we were given, we were exempt to continue construction during the lockdown. But I mean, I think the challenge actually is getting labor to the site, even though we're allowed to continue. Workers are freaked out, understandably. They don't want to necessarily take the risk. We're certainly not going to make anyone take that risk. And so any project that even remains open is working extremely short-staffed. And I think the other sort of big thing here is the municipal partners that every developer relies on, DOB, FDNY in New York. But yeah, the building department, the fire department, the local utility companies, all those are crucial partners in any development. And those agencies are extremely, especially in New York, are extremely backed up right now. In New York, they're really focusing on emergency work, such as temporary hospitals, and as they should be. And so I think part of the challenge, while you're under construction now, is trying to figure out the delay, and that's the part that we're just, we can't really predict. But there's no doubt every project that's under construction right now in New York will be delayed. Some of it will be due to labor, some of it will be due just to delayed sign-offs. And so that's what all developers right now are doing, kind of playing a little defense and trying to shore up cash flows, because I don't think 2 months ago any developer sort of projected the cash flows accurately in 2020 for sure.
That's certainly the case. Here, America is building in various parts of New York, but also in Florida. We also have projects in Europe. There is no place on the globe, there is no one area that has not been affected. Can you share some of your insights of how the various projects in various locations, how you're dealing with the administrations, and where do you see the trend is going?
Yes, New York is the only place that basically stopped construction. We are continuing to build in Israel and in Germany. And in New York, they stopped non-essential construction. So we stopped some of our sites. Some of our sites are continuing to work because of safety issues. We have to finish certain elements until we get to a safe place, and then we will have to stop as well. I think this situation could not last for too long, and I hope that in the next months they will reopen it and will ease the curfew basically. And we have few buildings that are nearing completion, which is it's a very big hit on the carry and interest cost, and it's not good for developers to stop and delay construction. I think the main issue will be to work things out with the banks and to extend maturity of the loans, and there will be a lot of workout due to this situation. We don't have any idea of how the market would look in terms of sales on our condo developments after this crisis will be over. For now, we cannot sell, cannot show apartments, and we'll have to see. We don't know.
I think the section or the conversation about values is probably, nobody truly knows. It's probably the last thing you want is to try and give valuation to anything. Things are just moving so quick. I think we'll know when the dust settles in a few months from now, maybe early 2021 or 2021, we'll be able to take a look at values. And I'm thinking really about all sectors. I'm thinking about hotel sectors, which I think, again, are the hardest hit. If you think about every real estate sector, a tenant moves in. It depends. It makes no difference if it's logistics, if it's retail, multifamily, office. You move in, you're settled, you're footing, and you're there. And you sign leases, and they go for a long time. I think the one sector that is the largest concern for me is the hotel sector. We're talking about 70% of all hotels in the United States are now shut down. The predictions are that in the next few months, hotel occupancy on average will run at around 20%. Some pretty bleak numbers that are happening in that sector, and it's one area that I think is going to get very next to the retail sector, which we'll talk about in a moment. But you did mention late cycles on the various construction projects and what sort of marketing are happening. We have our marketing guy from Douglas Element, Ariel Tirosh. Maybe you can share a little bit of light with us. Is there even such a thing in a time and place like New York where you're not even allowed to show an apartment? What does a marketing guy to do?
Well, it's a tough question. Well, first of all, I wanted to say that the stop work order in New York for construction site, just looping back to Dvir's comment, because we're working on a project on Upper West Side. We're lucky enough to get the green light to continue right now just to finish the foundation, but that's not a sustainable situation in my eyes. I mean, the ramification of that could be worse than the pandemic. So there was a little uncertainty. They're working through it right now, but if you're about to close a project, you're about to finish a project, you want to sell units, pay the contractor, pay the bank now cannot redeploy the funds, and the cycles slow down even further. More so, the government has not even gave us a kind of prediction, which we'll have to do very soon. You can't just tell a business owner, shut your business down until November and we'll see what's going on. It's just not a possible situation. So I think that that situation should be, I mean, it has to be moving forward gradually, and we'll talk about it later, but at some point I'll have to roll out some kind of continuation to essential businesses. Listen, dry cleaners are working in New York, VIA drivers are driving, liquor store certainly opening. So if these guys work, I think construction can continue. And I'm not saying a liquor store is not an essential service, but you know, that's the way things are developing here. As far as condo sales, not happening. We are not allowed to show units by the order of the governor. So traffic is essentially not happening. And this is in a spring market. It comes after a couple of years of soft market, and it has been slowly gearing up to something that was supposed to be a tremendous spring market. So right now sales are not happening. It also came out very abruptly. Like, think about 2008, we saw things happening. We saw the clouds looming in the background. You get prepared, you hear the reports. Here on February, we're doing business as usual, talking about a virus in Asia, and then all of a sudden, boom, in March, we are stopping completely. What we see right now is the buyers that were in contract, not signed, but ready to get signed, ready to get a deal going, mostly stopped, just took a pause. The market is now waiting to see. On the bright side, buyers that are in contract, meaning contract signed and are getting ready to close, are continuing and are closing. We had our last closing on Thursday. We closed on a $5.5 million apartment in Tribeca. Buyers cash buy from the Upper East Side. They did close on the apartment, but they did put a hold on the unit in the Upper East Side they wanted to sell. So as far as sales, it is in the air. We do, the recent trend is virtual showings, in which you're providing a video walkthrough, either pre-recorded, or if you can access the property to clients, and the clients are kind of putting their, laying their ducks in a row to get ready for the day after. That's one thing. The other thing is that we're already seeing people looking for bargains, getting ready to look for bargains. Although the real estate market is much slower to respond than the capital markets, it depends how long it's going to take us for recovery. So right now we're seeing people that are getting ready. New trends are including like remote closings, Zoom board interview for co-ops. The co-ops usually are very, very conservative, but now they have no choice. 2 weeks ago, we closed with a buyer. He's 65 years old. He was scheduled for closing. He said, you know what? I can't come. It's too much. And so we arranged for a Zoom closing, and actually they approved him the following day. So we're looking for those signs of life, because right now, the best we can do, we hear about closing here and there, but in the best case scenario, things are going to start going back in very gradually, obviously, to normality in the summer. So we could have a delayed and active summer market, but that, at this point, it's hard to know.
Thank you. Thank you for that. Let me ask you, Michael, about banks in general, the activities of banks in general, specifically the commercial space, construction loans. What do you see on that front?
Michael Crane, or
Michael,
you're talking to me, still correct?
yes.
Okay, so the main factor here, first of all, is that to realize that the U.S. banking sector, unlike the Great Recession of 2008, is very well capitalized and in very good financial shape. Having said that, the capital markets are adjusting to the new reality and finding ways to come, with the impact of COVID on the overall economy and so credit risk on their loan portfolios. The major factor is the extraordinary low interest rates, which on the negative side have been partially offset by increasing spreads over the index rates for lenders as credit quality of borrowers and loans becomes increasingly problematic. So we're noticing this trend both in the commercial banks and also in the CMBS market, where credit spreads have been tightening significantly. We're seeing a slowdown, major slowdown in construction financing, as banks are, like developers, are obviously trying to assess what the market conditions are. And in addition, certain lenders, including, for example, the agencies, they're changing the terms that they're offering, even on the loans that they are actively considering at this time. So, for example, with the agencies, they've been requiring higher debt service coverage. They've been looking at lower loan to LTVs on the new loans that they're putting in place. And in addition to that, they are, in some cases, even looking for 12 months of debt service reserves. So it's really a change. It's definitely different than the way that they've been conducting business. But there is business going on. There is money out there. It's being deployed. I think where we're seeing a lot of challenges is actually getting to the bankers. The fact that they're all working remotely, the fact that credit committees are being done in video conferencing and things of that nature. It's really slowing down the decision-making process. We're finding a lot of banks are assessing whether or not they want to actively lend, if they want to do construction loans, for example, or stay in the sidelines. But the other factor is that there's this whole stimulus that's going on right now, where banks are so busy with these SBA loans that have been approved. And so a lot of their focus is on either servicing and renegotiating the problem loans that they have on the commercial side and the residential side. But in addition to that, they're basically just trying to stay away from the more complicated transactions. So they're sticking to the easy refinances with very low LTVs and things of that nature. These things are all, it's creating a lot of pressure on the market. Obviously, there's a lot of uncertainty. People don't know if they can approach their banks to talk to them. Difficult to get a hold of them. It's all of this, obviously, that I think, Joe, you were mentioning earlier with regards to valuations. It's a challenge for the banks also, because when they consider these new loans, there's this big question mark on valuating loans and whether or not, for example, in multifamily loans, if the rent rolls are going to remain the same, how that's going to affect the cash flow, and ultimately what impact it's going to have on the valuation. And obviously, the valuation is going to drive the proceeds on these rolls. So overall, I mean, we're finding that, given the stay-home requirements of the bankers, they're difficult to get to. When you sort of compile all of that together, it does create a challenging environment. I know that with us and with our team, when we're talking to a lot of these bankers, they don't have time to consider our loans because they're busy renegotiating and working on SBA stuff. So it's a challenging environment. But again, I think like everybody else, hopefully all of this is going to be short-term. Impact will be shorter than expected, and things will go back to normal with the banks.
It sounds like a tale of two cities. It looks to me that the well-capitalized lenders on the, not referring so much to the FDIC lenders, more like the private equity funds, are sort of like some of them are as much as shell shocked. I mean, I know I own some stocks with mortgage REITs, and those have been taking some very severe pounding. Some of them has dropped as much as 75%. You know, I think the anticipation of I might consider even a tsunami default, certainly again going back to certain sectors, is becoming more and more of a possibility. If you have a center, and retail has been hitting very hard over the last 5 years, now get a break, and you're now hearing from tenants and some nationals that are now going through another wave of not being able to pay. It's going to be really interesting. Michael Dinowitz, I want to ask you, as an attorney that represents sometimes lenders, sometimes borrowers, how do you advise your clients in such times?
So I mostly personally represent borrowers, owners, borrowers, investors. Right now, although nobody's been unaffected by this, the folks that are having the most immediate crisis situations are the hospitality owners, the hotel owners, and developers who are in the midst of a construction project. So I represent suburban hotel and hotels in gateway cities, and it's been rough. Number one, a lot of these loans are with CMBS lenders. There's nobody there to talk to immediately. You have this whole dynamic with sending notices out to master servicers who have actually responded much more quickly than we expected, but it's been a form letter. They're kicking this over to a special servicer. So before you even get to a human being, it's going to be 3 to 4 weeks, and that's very frustrating for people who are basically going dark or have gone dark already. We have had one situation that's very interesting in New York. I represent a very large hotel in New York in Times Square, 665 keys. And the city approached us to basically triple net lease out the property through July. So we're negotiating a deal with the city right now. That doesn't come without concerns about liabilities, et cetera. And surprisingly, this hotel happens to be an independent operator, but surprisingly, some of the big brands, national brands, have taken a very harsh approach to folks who are coming to them for permission to convert their hotels to house hospital patients, and have been, I don't want to say the names of the brands, but you know they're household names, and have been very reluctant to allow their franchisees to help out, which was a big surprise. We thought they'd jump at the PR opportunity and, of course, help the community. In any event, the hotel operators are having a tough time. Most of them are not making debt service payments in April. For sure, they're not going to make them in May. And we're waiting to, hopefully get reasonable lenders who are on the, willing to give extensions, defer interest payments, and we'll see how those workouts go. And the other sector that I was discussing are the development construction projects, which Devere and Ariel spoke to. I represent a client with a large condo development in Forest Hills. They're shut down. Thankfully, the lenders have been reasonable with respect to opening up a discussion about extending times, but they have not agreed to defer interest. And as Devere said, those interest and carry costs are a big burden on developers developing, condo and residential housing projects. So it's challenging, and we hope that everyone will act reasonably and that we'll be able to come out of this alive.
Thank you, Michael. Diego, we had a conversation about leverage. We talked about a specific project, a great project right here in Wynwood. And the conversation was about 65% or stretching out to 75, even 80. I'm starting to question the question. You know, is it the right thing to do to take such a high leverage? I'm not certainly not sure anymore. You know, black swan events. I don't think that this pandemic cannot even be considered a black swan event. It's probably a purple swan event in our lifetime. Something like this. But how's the Florida market? What it is that we're doing to things are staying as normal as possible?
Sorry, Joe, you cut out at the end. Could you repeat the question?
Sure. How are things in the Florida market? You have a number of projects, both in Wynwood and in other locations. The projects are a hotel component. How are you day to day with the team?
Sure. I'd say that it really varies across asset class and the stage that the project is at. So for the properties that we currently own, surprisingly, most tenants, I would say about 3/4 of both commercial and residential tenants, did pay rent through April, which we did not expect. A few of our residential tenants did ask for reductions or structuring of delayed payments, and we're working with them on those. And as far as our commercial tenants, a few of them did ask for rent forbearance. For the time being, we've been referring our commercial tenants to the government programs under the CARES Act and other Florida programs. In terms of our development projects, we're actually still busy and making progress. We're still talking to local banks for construction loans, and we're still speaking with investors. And what we found is that there's still an appetite. It's certainly more selective in terms of construction lenders that are interested, but there's still an appetite to finance these types of projects. And since the delivery date would not be for another 2 years or so, I think investors are generally less concerned about the virus. In terms of for value add deals where we were under contract, those deals are getting repriced. I think us and a lot of the developers that we have spoken with are assuming there's going to be no rent growth for the next 2 years. And you're trying to back into your numbers to make sure that you can still get to your return hurdles, assuming that those low rent projections. So generally that sort of works out to call it a 5% reduction in prices that were negotiated pre-coronavirus. In terms of new deals, at least for the time being, we're not really seeing any distress yet. To the contrary, what we're seeing is that most deals that were being marketed are actually getting pulled off the market when the seller can wait. So we do expect transaction volume to reduce, to drastically reduce in the next few weeks. And then in the next few months, potentially, that's when we expect to see some more distressed opportunities.
Thank you, Diego. Anna, we're talking MBS and private lenders. You have taken a loan from one of the agency with Fannie. Is there a change of conversation with the lenders? Is there anything that's being offered to multifamily owners?
So it depends by lender. Fannie and Freddie came out with a forbearance agreement, which we're actually looking to do for a couple of our properties. The one caveat they have in there is that you cannot evict anybody. Meaning, if you had an eviction, you cannot evict that person until you pay off whatever forbearance amount they give you. So they're still kind of tweaking that portion, and we're waiting to see whether they tweak it to be only people that fell behind after the coronavirus, not people that were already behind. When it comes to local lenders, it all depends. City National is giving forbearance to at least 90 days to pretty much anybody who asks. Bank United is doing it on a case-by-case basis. So I think banks are working with people, but are not just going on a blank canvas and saying everybody gets help.
Thank you. You know, we're seeing a spike of about 40% increase in e-commerce, essentially, primarily for essential goods. and a drop of about as much as 60% in purchasing of essential and non-essential goods. If you think about the US economy, 70% of our GDP is consumer. So there's going to be a large impact. The second thing that we're noticing in the world of retail is that, you know, retailers essentially always anticipate a certain amount of demand, and nothing like this can be anticipated. So we're seeing some pretty good shortages in all fronts. Again, I don't think that you know, retailers that have not learned or readjusted in the last 5 years are in for another very turbulent time. Jerry, what's your opinion about the near-term and long-term future of brick and mortar retail?
I think brick and mortar retail are, other than neighborhood centers, small centers, I think that's going to, as far as I'm concerned, that's not going to be a good story long-term, short-term or long-term. It was funny enough, I was in my neighborhood just recently going to Passover shopping, and with all my safety gear on, obviously. And the shopping center that was historically, for the 30 years I lived in this neighborhood, it has had a vacancy. In 30 years, over 30 years that I've been living here, has now got, I would say, 30% vacancy, which is amazing to me, just amazing to see that. And, you know, I don't know whether it's just the lack of just the expense, the rents that's way too high for retailers to make it. I know in Manhattan, they certainly are too high to be able to survive. You know, 1,000 square foot user that's got to pay, you know, somewhere around $200,000 a year in rent. It's got to do a huge amount of business to be able to do that. And I don't know how you generate that kind of business in 1,000 square feet. It's got to be a real specialty situation. So long term, I see that the brick and mortar guys are going to have to be a lot more innovative as to how they deal with the business. I'm sure a lot of business is going to go internet with the internet situations. You know, from my perspective, I think investing in logistic warehousing situations and industrial buildings probably makes more sense than investing in retail centers. You can see what's happened right now. I mean, if you own a retail center somewhere in New York or in, you know, Florida or in LA or in the big, you know, the big cities that have been hit, you're probably not collecting any rent, zero. And there's a good reason for it. They're probably coming into the door. So long term, I see that these big retailers or big brick and mortar situations are going to have to readjust, and they better readjust fast, because otherwise they're going to be closing down. In fact, today I just saw an article. I'm sure you all got the same article, that Dick's is now thinking about filing a force majeure, taking advantage of a force majeure in their leases, because they think this is, you know, worse than a war. I've also had a conversation this morning with a large owner, a nationwide owner of retail, major retail, and they're going to readjust. They're going to take some of their big stores and make them into, you know, front retail, back warehouse. There's going to be a huge readjustment in the retail business, and that's got to do with the internet, and it's got to do with people not wanting to congregate like they did in the past. That's my opinion about retail. I'm not very high on retail at this point.
Yeah, I hear you. Readjustments, and again, you know, it's you know, taking into account that for obvious reasons we're seeing big spikes in e-commerce. I think that retailers, you know, simply have to go back to thinking about experiential. Experiential retails are simply doing better. Apparel has been struggling for a very long period of time and probably will continue to do so. Essentially, anything you can buy online is going to go through, going to have to readjust again. bricks and mortar, size of stores, the proper use of stores. We have some questions. I'm going to open up some questions that were emailed earlier during this Zoom conference to some of the members of this call. I'd like to address the first question coming from Israel, from Ron Santicario, my dear friend and good partner. The first question is addressed to Anna. How do you see the multifamily sector going to go through these hard times? And when do you suppose we're going to start seeing a positive swing to this pandemic?
So I think for the multifamily sector, you're going to see a short-term pain. You're going to see the, your collections coming down, probably your leasing slowing down quite a bit, of people being afraid of going to see units or things like that. But I still think, especially in the workforce housing, we're still going to come out strong. There's still a lack or a shortage of workforce housing. And the one good thing about this workforce is that if you were a truck driver for DHL, you can be the truck driver for Amazon. So their skills can be transferred to various different jobs that are currently being available and they're actually booming because of the COVID-19. But with that said, it's short-term pain, probably, I would say 3 to 4 months. And you start going to see it probably picking up again and become strong again. I think probably from all the different sectors between hotels, retail, probably multifamily will bounce back first. Just Amazon hasn't created any housing in the internet yet. So we're still going to need housing, and you're still going to have people having to move, having to find affordable housing. People losing jobs are going to start looking to, okay, maybe I won't be in the Class B apartment with a nice pool and garden. Let me go down to the next level. Let me, move in with family and friends. So you're still going to see housing needs.
Yeah, so that's I mean, if going back to the previous recession, we've seen that the one sector that fared the best was always housing. And when you work, invest, and put your attention into workforce housing, that's definitely a very resilient sector. So we'll hope for the best there. Another question coming from Chris Hunt. I'd like to address it to Dvir. What are the leveraging tools in your disposal to grow your business during this pandemic?
You need good investors that could, in one hand, absorb the shocks, and on one hand, go for the next opportunities when they come. And I think we have a set of very good investors, both institutionals and private and semi-institutionals. And that's what you need. And also you need to be open-minded to jump to other geographies, other sectors, and we have done it in the past, in the past crisis.
In fact, if I remember correctly, coming out of the first crisis, I think you found some pretty good opportunities. I remember you bought a piece of land in Williamsburg. I love this story. I remember it was 2010. Dvir was one of the only ones shopping around for land. And he found this a great site in Williamsburg. There was already a foundation has been poured. It was a stuffed project. And I think you picked it up for a song. So, we're looking out for you to pick up some good opportunities because, what's different between, I think, this crisis and the one that we went through in 2010 is that we have tons of dry powder. I think it's very, very different times. If you compare the two, if there's such a thing to compare the two, there was plenty of capital. There was that is now searching for deals. There's just plenty of funds. The numbers are moving all the time, so I'll try not to quote anything, but essentially 2008 was a liquidity crisis. There was no capital, a shortage of cash. I think we're also adding into this pandemic with here in the States, at least, but a very, very solid economy. We haven't seen those type of employment numbers probably in over 50 years, maybe even more. So, certainly hope this is going to be, I think all of us, we hope this is going to be a very quick recovery. more of a V-shaped recovery, not so much as 2008, where it was like a long, drawn-out crisis. So we'll hope for that. I have another question from Ron Sadikaria from Israel, addressed to Ariel Tirosh. Barring the fact that nobody knows what, nobody has a good crystal ball, but how do you suppose you'll be pricing product, condos, units, as far as COVID-19 is concerned? Is there going to be any adjustment in your mind, any concessions that are needed, or simply let time sort of cure itself and let things get back together?
Well, while I'm pulling out my crystal ball from the drawer here, if you can enable me to share my screen, I just want to put one thing in context, and that's how do we stand in the market at the moment before the virus. A brief review over the recent report that came out actually right in the end of March, beginning of April. You quickly see that the prices have been dropping for a while. In the last report, the prices dropped to $1,540 per square foot, you know, from $1,769 last year. It's across the board, of course, in Manhattan. But number of sales started to increase over 13%. And inventory at the same time was falling. And so less apartments, more sales volume, higher sales volume, and cheaper prices for purchase. So the market was at a great point at the moment we got into this new situation. And mind you that this was a market already soft for a couple of years. The peak was actually in 2016. So on prices, we cannot know until we know what is the impact of this virus for long term, meaning how long is that cost? Are we going back to work in June, July, August? Nobody knows. Next year. But a couple of fundamentals that are very essential for Manhattan, that's the draw that a lot of people find in this market. It's an awesome market. I mean, it's like no other. Even if you compare it to Paris or London, we are limited with space. With all due respect to, we're on an island, and all respect to Brooklyn, all the boroughs and the tri-state are basically orbiting around Manhattan. I remember after September 11, a lot of people flee the city and moved out. And that's, to Jerry's point, that's true, that happened. But a year later, they all came back. Actually, a lot of the people we're talking to right now are in the Hamptons, are in the Upper Westchester in Connecticut, but they can't wait to come back here. And if you've seen the last year, some huge bets were made on Manhattan higher end residential by very sophisticated players, Jeff Bezos, Bill Ackman, Ken Griffin, spending $220 million on an apartment. So it's a place where people don't have to kind of live here. It's not a calculation costs against benefit, but it's more like they want to live here. I've been here for many years. I'm telling you, it's one of the best world to live at. So if we are, let's assume everything is done within a month and we are doing a V shape, whatever shape, the likelihood of things correcting quickly is pretty good. The longer it lasts, the more we'll see weak spots in the market. Developers that have to sell, individuals sell, they have to get out, and that obviously creates a domino effect. I hope we're not going to get there. I hope we are soon enough. We'll see that the low interest rate with attractive pricing still competing with rent prices, and so that's what I'm hoping for, essentially.
Thank you for that. We certainly are with you with that positive outlook. Michael, talking about positive outlooks, we have a 2.2 trillion, Michael Corbin, we have a $2.2 trillion stimulus package. We have not seen something like this. Bipartisan effort came around very quick. Another small comparison, 2008, where the Fed have delayed and argued and took their time, and the results have seen what we saw back then. Now we're looking at very quick Congress coming in, and in a matter of days coming out with a tremendous amount of money to infuse into the economy. How do you think that will impact going forward?
So the impact is no doubt going to be very strong. I mean, we really are very fortunate in this country, like I think you said it, Joe, earlier, that the $2.2 trillion that was passed is larger than the GDP of a lot of countries. Not many countries are in a position where they can literally snap a finger, pass a law, and inject so much money into the economy. The stimulus package is the CARES Act, which, for the people in Israel or others who may not know, is the Coronavirus Aid, Relief, and Economic Security Act. It is $2.2 trillion. The main part of it that really is relevant to us and applies to us in this industry is the Paycheck Protection Plan, or the PPP, which authorizes local lenders to provide up to $350 billion in federally guaranteed loans that are designed to help small businesses pay essential expenses, primarily payrolls. And that basically is designed, the $350 billion is designed to cover small businesses for the next 2.5 months, so that's 250% of their existing expenses. This will no doubt help significantly because obviously it's the workforce that's living in Anna's development and in other parts of the country that are relying on these for their rents. And at least for the short term, this is going to give them a lot of relief, and hopefully it gives them the capacity and the ability to, through continued salaries, to be able to cover their rents and not. Am I muted, guys?
No, we can hear you fine.
Okay, I got a message that I was muted. Sorry. So basically, under this program, small businesses will also be able to use the loan to pay other expenses in addition to payroll. And that includes rent, utilities, interest, employee benefits, and also commissions. As long as 75% of the money that they utilize from these loans are applied to the payroll. It's important to note that the payrolls are capped at $100,000 per employee, and that's the annualized income. These loans are for 2 years. They're carrying an interest rate currently at 0.5%, 50 basis points, with no additional fees attached. The interest can be deferred for 6 months, and these loans are unsecured. So really, the terms are really unprecedented. And the most important aspect of it is that if the proceeds are applied properly by these small businesses, where they're applying 75% to their employee salaries, then the government, they'll be eligible for the government to basically forgive the loan entirely. So with all of these aspects, I mean, the expectation is that these companies will stay afloat at least for the next 2.5 months. They'll keep their employees, and hopefully all of that will trickle down to their ability to pay rent, service their residential, and in turn, the commercial rents to their landlords. And hopefully that'll trickle down. And if the effect of COVID will be short term, then obviously this will probably stop. Now they're currently also talking about other stimulus factors, and involving either infrastructure or even more salary benefits, and that's all yet to come. But fortunately, there's a lot of bipartisanship going on right now, and people are cooperating with each other rather than being political.
Thank you for that, Michael. We have more questions coming from the audience. The next one is addressed to Diego, but I also will like to ask Gary at the same time. Procurement in the sector, very important area of the development project. Now with the tax crisis happening between the United States and China, tariffs, what do you think the effect on pricing procurement of steel and other goods coming from China going to have on your market? Same question also for Jerry afterwards, but we'll start with you.
Yeah, it's a very good question, and we've actually been wondering the same thing ourselves. we are speaking with our construction partners. I think you're gonna have two effects. You're gonna have, given the larger amount of unemployment, potentially reduce labor costs, and that's the big one of the overall cost to develop a project. So we think that's going to play to our favor, but at the same time, you may still have broken supply chains that is going to increase the cost of steel and other materials we import. So it's hard to say at this moment, to be honest. I think we're sort of expecting that overall construction prices are going to stay flat given the decrease in demand for construction we expect to see. But we're speaking with our construction partners to see any more knowledge they have on that.
Thank you. Jerry, I can probably share that there's been a good amount of conversation between us in regards to procurement, in regards to renegotiating maybe of some contracts. It's a whole new world that we're facing.
Joe, you're coming in and out, so if you could be a little clearer, I can hear you better.
The question related from one of the audience members in regards to procurement and in regards to changes of supply coming from China, such as steel, such as other materials that you might use. How do you see that affecting your projects going forward?
We haven't seen any issues with procurement at all. Given the lead times, we see product from China coming in fairly quickly. Most of our product is sourced locally, but steel and glass does come from China, and those are both long lead time items. So we don't really see any issue. There's really no pricing issue right now either. We don't really see a big softening in prices, even whether it's on the labor side or on the material side. But on the other hand, we don't see increases either. So I think everything's going to be level for quite a while until things simmer down. We think, and some folks think, that the administration and Trump is going to relax some tariffs, which may help commodity prices, et cetera, as far as glass and steel is concerned, and other types of items that have been hit with tariffs. But that's probably in the works. We haven't heard anything definitive about it, but we think it's coming. So overall, as far as procurement and pricing is concerned, we don't see an increase. We don't see a significant decrease. So we see a leveling off, and I think that's good for us because we can actually predict pricing, and we're negotiating construction contracts right now, and we're not finding that anybody is in any hurry to put in any increased provisions for commodity prices, et cetera. So I think people are just happy to have the work and not take any advantage of the slowdown in the market. And I think everybody feels that in the next couple of months, things are going to be more steady. The one thing that we are finding as far as work is concerned, Chicago work has not stopped like it did in New York and in Boston. So what we are finding is that even work has not stopped in Chicago. I think that what's happening in that marketplace is when you're doing a union job, that the unions become much more active as far as the safety regulations are concerned. And because of that, a lot of the unions are putting in demands that maybe rightfully so, as far as social distancing or distancing is concerned, which makes for a very unproductive job. Additionally, we think that there may be, depending on the severity of what's going to happen as far as as COVID in the Chicago market, that the governor may relent and stop all construction. That's not needed. So we are holding back, waiting to see what's going to happen over the next few weeks when this pandemic actually reaches its epic heights. And I think the smart thing to do is to sit back and just wait and slow things down until there's a little more certainty in the marketplace. And I think the lenders have the same attitude as we do, and there's no use taking out a loan and sitting on carrying costs while work is not progressing. So as far as Chicago is concerned, we don't want to be in the same boat as developers in New York, sitting with carrying costs and not being able to complete projects. So we're taking the wait and see attitude, and we're going to wait and see for the next 2 or 3 weeks. We think that that's going to be when the height of the epidemic is going to hit, and then we'll see how things flatten out after that. Wait and see.
Wait and see. Our conference is coming to an end. We have the last several minutes. I want to ask David Brickman, what do you think is the new norm? Looking out 6 months, 18 months, are you expecting to see any changes in behavior? Are you expecting to see any changes in consumption? Are we going to yesterday's normal? Are we looking forward to a whole new set of
yeah, I think I'll borrow one of the participants' crystal balls and try and figure this one out. We don't know. I mean, we don't think things are going back to the way they were. I think there is going to be a new normal. Certainly in the next 12 to 18 months, at some point things will return to normal. They typically always do. But you know, we're looking at we've been doing due diligence on an acquisition that involves some unsold condo units, and now we have to try and figure out if we are, you know, what's going to happen in the next 12 months. With we thought a big buyer of these units would be empty nesters. I don't, you know, I think Joe, you know, we talked about some of the young people moving out to the suburbs. I mean, the same thing could be said for the empty nesters who, you know, developers rely on to sell their homes and move to condo amenity lifestyles. And I think in the next 12, 18 months, we don't see that happening. Certainly the way it did, you know, maybe there still will be, but so we're trying to understand the impact of various demographic, you know, buyers, to just try to understand how this, you know, because I think the health crisis is going to be the most important thing. And if you're in that, you know, 55 and over, or 60 and over, and you're probably going to stay in your home for a little while longer, and wait this one out. I think everyone's going to wait it out. So trying to analyze what, you know, it's gonna mean prices are going to come down. It's going to be more carrying costs if you're going to be forced to close on a transaction in the next 6 months. Your, you know, velocity is going to be a little slower, and you know, there will be a normal, but it's going to take longer than I think some people are anticipating.
Thank you for that. And
Joe,
yeah, sure.
I'm going to sign up, but let me leave this conference with a very positive note, and that is, yes, this crisis is a terrible crisis. I've been around a long time. This is my third or fourth real crisis, whether it's economic or 9/11, et cetera, et cetera. But I can tell you this, that every time we've went through a crisis, when the crisis was over, we always came back stronger and better. So I think I can leave you with that very positive note. And I thank everybody. Have a great holiday, and we'll see you on the other side of this, stronger and happier folks. Take care.
Thank you for those words, and thank you for everyone who participated, for those who called in to listen, for those who had emailed and asked questions. Happy holidays. Stay with your family. Stay safe. For those who are celebrating Passover in a couple of nights, just want to wish you happy as much as you can. Stay close to your families. Same thing as far as Easter goes, and in general, spring holidays. Thank you all, and God bless. We'll talk again soon.
Joe, thank you so much.
Bye.
For the best.
Chag Sameach.
Thank you. Chag Sameach.
Chag Sameach, everyone.